Welcome back, ladies and gentlemen. Now let's continue with the general ledger account. And here we are saying that the general ledger account is a primary component of a general ledger. So this we had explained on the previous class of where we are saying that the primary component of the general ledger is the general ledger account. So this is just a repeat of what we had explained. And then again, we are saying that general ledger account records all transactions for that account. So what we mean here is that when you want to record the transactions of assets that you've bought, all the transactions of those assets will be recorded in the assets account, or rather the general ledger account for assets. And then when you have expenses, whether they are operational expenses or non-operational expenses, all those expenses will be recorded under the general ledger account for expenses. And then when you have liabilities, whether they are long-term liabilities or short-term liabilities, all those transactions for liabilities will be recorded under the general ledger account for liabilities. The same applies to when you have capital. You could be having capital injection from various shareholders or various proprietors. So all those transactions for capital, that is from many proprietors or from many shareholders, they will be recorded under the general ledger account for capital. The same applies to revenue. When you want to record revenue that you've received from your customers, all the transactions will be recorded under revenue or other general ledger account for revenue. And then next, we're being told that the transactions are related to various accounting elements. And these elements are assets, we have liabilities, we have equity, we have revenue, we have expenses, we have gains, and we have losses. So this rather the records that we are rather the transactions that we are supposed to record in this general ledger accounts will relate to assets, they will relate to liabilities, they will relate to equity, they will relate to revenue, they will relate to expenses, and then they will also relate to gains, and lastly they will relate to losses. So let us move on with the general ledger account. Now we want us to look into details of the general ledger account. So we'll start with the assets. So this is an overview of the general ledger account as we had seen earlier. And then now we have various general ledger accounts. We have assets, we have liabilities, we also have revenue, we have expenses, and we also have equity. So when we talk about assets, what do we mean? What do we mean by general ledger account for assets? So an overview of what we have in assets, we have motor vehicle, furniture, we have money, we have stock, inventory, we have receivables, and then we also have goodwill. But remember, within assets, we have non-current assets, we have current assets, and we also have maybe intangible assets, but intangible assets are part of non-current assets. So let's just see what we mean by assets. So when we talk about assets, we are saying that an asset is anything of value or a resource of value that can be converted into cash. So anything of value or a resource of value that you can convert into cash is an asset. So from the layman's point of perspective, we are saying that that thing that you have that you can sell, whether it is a pair of shoes, whether it is a clothing, whatever it is that you can convert into cash is an asset. And then we are saying that individuals, companies, and governments own assets. So we are saying you as an individual, you own an asset, companies own assets, and governments also own assets. I think that one is self-explanatory. And then for a company, we are saying an asset might generate revenue, or a company might benefit in some way from owning or using the asset. So when a company is having a vehicle, maybe it's not using the vehicle maybe it's not selling the vehicle, but is using the vehicle to transport maybe goods from suppliers, and then maybe transport goods to customers. So that's the gain that is getting from owning a vehicle by using it in transport from the suppliers and then from the company to customers. So that's the meaning of an asset. And then we are also saying that, so now this is an overview of what assets is all about. So under assets, we have non-current assets, and then we also have current assets. So under current assets, other non-current assets, we have tangible assets, we have intangible assets, and then we also have natural resources. So when we talk about assets, when we talk about non-current assets, what do we mean? So non-current assets, just a moment. Non-current assets, here we mean. Non-current assets are assets whose benefit will be realized, whose benefits will be realized over more than 1 year and cannot easily be converted into cash. The assets are recorded on balance sheet at acquisition cost, and they include property, plant and equipment, intellectual property, intangible assets, and other long-term assets. So we are saying that non-current assets, simply put, are those assets that you cannot readily convert into cash within a short period of time. So if you must convert them into cash, it will take a longer period of time, and normally, and the long period of time will always be more than 1 year. So let's say maybe owning a company, then you are selling books, and then you also have assets like furniture, you have vehicles, and you also have maybe land. Maybe the land is where you want maybe to start a factory of manufacturing the books. But when it comes to the situation that now you have to close the business, and then you want to sell these assets, so you'll be having the non-current assets, of which we have these goods that you are selling, the books. So those books you can sell within a short period of time, within less than a year. But and the land and the fixed assets that you have, the vehicles and the furniture, might take you longer than 1 year to sell. So we are calling them the non-current assets. So we are saying the non-current assets are assets whose benefit will be realized over more than 1 year and can easily be converted into cash. And cannot easily be converted into cash. The assets are recorded on a balance sheet at acquisition cost. So we have here property, plant and equipment, and we are saying that property, plant and equipment refers to fixed assets such as land, we have buildings, we have motor vehicles, whereas intangible assets, the assets that lack the physical form. So when you have an asset that lack the physical form, that one is intangible asset. So somebody might ask, what are these intangible assets? We'll come that later as we proceed. So I hope we understood what is meant by non-current assets. So let's go and see the different types of non-current assets. So under non-current assets, we have tangible assets, we have intangible assets, and we also have natural resources. So what are tangible assets? So when we talk about tangible assets, we are saying here that tangible assets tangible assets refer to assets with physical form or property that are owned by a company or a business and are central to its core operations. So those assets that are owned by a business and are central to its core operations, we call them tangible assets. So such kind of tangible assets could be a motor vehicle, could be furniture, it could be land, okay? They could be computer and equipment. So we are calling them tangible assets. So tangible assets are physical form or property that are owned by a company and are central to its operations. Okay. So when you have a vehicle, maybe you are selling goods, you are selling books. So this vehicle, you can use them to transport your books. So they are central to the operations of your company of selling books. Or you can as well use the vehicle to transport your employees, and your employees are a part of your operations in terms of what the goods they are selling. They talk to clients, they go to clients, but they use the vehicle to transport, they use the vehicle to go to the clients, or they use the vehicle to get goods from the suppliers. So the vehicle here, you are saying it is central to the operations of your business. So it is an asset. Again, we are saying that the recorded value of tangible assets is its original acquisition cost less any accumulated depreciation. So when you buy an asset, or when you buy a vehicle as an asset, or when you buy a furniture as an asset, you will record that furniture or vehicle at the original cost, and then you'll net off the accumulated depreciation. So what do we mean by depreciation? So depreciation here, we are saying that it is a non-cash notation that reduces the value of an asset over time. So when you buy a vehicle today, and let's say you want to use it maybe a period of 4 years, after 4 years, you cannot sell the vehicle at the price that you bought it. It means the vehicle will have reduced the value. So that reduction of the value of that vehicle from the original cost is what we are calling the depreciation. So the recorded value of tangible asset is its original acquisition cost less any accumulated depreciation. So accumulated depreciation here will be the loss of value on the first year, or maybe the loss of value on the second year, again on the loss of value of the third year. So if you sum all those, rather if you sum the losses of values of each and every year for 3 years, we are calling that one accumulated depreciation. So accumulated depreciation is a non-cash notation that reduces the value of asset over time. And then we're also saying that not all physical assets are depreciated. Assets such as land are held at cost, even though they tend to appreciate in value. So when you buy land, land will not depreciate. When you buy land today at $300,000, come next year, the land will not be sold at $250,000. It will be more. So land does not depreciate. Land does not reduce in value. Land appreciates. The value of land will always be positive. So we are saying not all physical assets are depreciated. Assets such as land are held at cost, even though they tend to appreciate in value. So they appreciate in value but in our books, we'll record them at cost, at the original cost of which we purchased them. So I hope, ladies and gentlemen, you understand what we mean by tangible assets, and that not all physical assets are depreciated. So let's move on. So we also have intangible assets. So what do you mean by intangible assets? So when you talk about intangible assets, we mean intangible assets are assets that lack physical form but offer economic value to the company. They lack physical form but offer economic value to the company. So intangible asset is something that you cannot touch. They don't have any physical form, but they have value to the company. Example of such assets include goodwill, intellectual property, such as trademarks, patents, and copyrights. Okay. We have goodwill, we have intellectual property, such as trademarks, patents, and copyrights. We'll get the explanation of this intellectual property, trademarks, patents, and copyrights later as we move on. So what is goodwill? So goodwill, we are saying that the concept of goodwill comes into play when a company looking to acquire another company is willing to pay a price premium over the fair market value of the company's net assets. Simply put, let's take an example. Today you have a business that you want to sell. So your business is having assets. Let's just talk of the whole of your business. You valued your business, you want to sell it, or rather the value of your business within the market is $300,000. That's the value of your business. But when somebody is coming to buy it, you want to buy it at $400,000. So the above market price of the value of your company or of the value of your business is what we are calling the goodwill. It is a premium above the market price. So the market price of your business is $300,000, but you are selling it at $400,000. So the difference between $400,000 and the $300,000 is what we are calling the goodwill. Okay. So goodwill comes from into play when a company is looking to acquire another company and is willing to pay a price premium or more money than the fair market value of the company's net assets. So that's what we mean by goodwill. Okay, so again we can also say that goodwill, what forms goodwill now? When I come to buy your business, forget about the net assets. So we are talking about the goodwill. So you have the net assets, but I'm buying it more than the value of the net assets. So the goodwill will come from the customers that you own. Remember, the customers are not part of net assets of your business. So the customers, the environment where you put your business, maybe the security, and there's good security, and there's a good market for your there's good market for your products or maybe your services. So when I come to buy your business, I'll be buying the net assets. Then also I will also be getting the value of the good customers that you have, the good environment in terms of security that you have, the good name of your products that you have. So that good name, that good environment, the good customers that you have, that good rapport that you have with the suppliers or maybe the bankers. So that's what we are calling the goodwill. So that's the simply put, that's the goodwill. So again, we are saying that the elements or factors that a company is paying extra for, or that are represented as goodwill, are things such as a company's good reputation, a solid, loyal customer or client base, brand identity and recognition, and especially talented workforce and proprietary technology. So this is what forms the goodwill. The good reputation of the company, the solid customer base, the brand identity, the recognition, the talented workforce, and the good technology. So these are what the things that we are calling the goodwill. They are not part of the net assets of the company, but they form part of the goodwill. So again, we are saying that these things are in fact valuable assets of a company. However, they are neither tangible physical assets nor can their value be precisely quantified. So the goodness of your customers and the goodness of your workforce cannot be precisely be quantified. So, but they form part of the goodwill. They are valuable assets, yes, but you cannot quantify them precisely. So they form part of the goodwill. So again, let's move on. Let's proceed on. I hope you guys have understood what we mean by goodwill. So now we are moving to intellectual property. This is still intangible assets. We are still under intangible assets. Assets that you cannot touch or they don't have physical form. So what do we mean by intellectual property? So when we talk about intellectual property, we are saying that intellectual property is an umbrella term for a set of intangible assets or assets that are not physical in nature. They don't have any physical form. Intellectual property is owned, legally protected by a person or a company from outside use or implementation without consent. So intellectual property, we are saying it is legally owned. It's legally owned. It is protected by a company or an individual from outside use or implementation without consent. So this could be an idea that you legally protect. So maybe you've come up with an idea that you want to implement, maybe an invention of a vehicle, but you will protect that idea that you have, you've invented it. So when somebody has to use it, they have to buy it from you. You have to authorize them to use them. So the idea that you have is an asset, but it does not have the physical form. And then we are also saying that intellectual property can consist of many types of assets, including trademarks, we have patents, and we also have copyrights. So intellectual property, we have trademarks, we have patents, and we have copyrights. So all these are what we call intellectual property. So intellectual property infringement occurs when a third party engages in unauthorized use of the asset. So when somebody uses that intellectual property, that intangible asset, without your authority, we call it an infringement of the intellectual property. So let's move on. So we are saying again that intellectual property, okay, Intellectual property. The concept of intellectual property relates to the fact that certain products of human intellect should be afforded the same protective rights that apply to physical property. So the same protective rights that apply to those physical property or tangible asset should also be applied to intellectual property. So this intellectual property, we mean patents, we mean copyrights, we mean trademarks, and we also mean trade names. So what are patents? What do we mean by patents? When we talk about patents, or rather when we talk about copyright, let's start with copyright. We are still on the intangible assets. So when you talk about copyrights, we are saying that copyright protects authorship expressed in various tangible forms. Included here are books, works of art, songs, or movies. So when you have a book, you will not authorize any other person, or rather, if you are the author of a certain book, you will not authorize another person to make that book without maybe giving you some money or some value to use the rights of authoring that book. So you are saying that you have the copyright protection of that book, or maybe you have an art, and that work art, you can only authorize somebody to use the work art. They cannot use that work art without your authorization. So you have the copyright protection. Maybe it's a song. So that song, when it is being played, or rather, somebody cannot just use that song anyhow. So you have the copyright protection of that song. So applies to movies. So you cannot download a song. This is an example. You cannot download a song from maybe YouTube and then use that song as if it is yours, because it has copyright protection. The same applies to movies. So we are saying that copyright protection usually extends 70 years beyond the author's natural life. So when you make music today, so the music and the protection of the rights of that music can be more than 70 years. It then means that when you die at 70 years, the protection of rather the copyright protection of your music can still go beyond your death. They can still go beyond the 70 years. So that's what we mean by copyright protection, authorship expressed in various tangible forms. Or rather, copyright protection usually extends 70 years beyond the author's natural life. So what do you mean again by patent? So when we talk about patent, we are saying that a patent protects new inventions such as manufactured items, machines, industrial processes, chemical composition. The interval of protection is dependent on the type of patent given. A design patent usually lasts for 14 years, while a plant or a utility patent lasts for 20 years. So we are saying that a patent protects new inventions such as manufactured items. So when you have a new invention, you'll have a patent right. When you have a new invention of a machine or industrial process or chemical composition, you'll have a patent protection. And then a design patent usually lasts for 14 years, while a plant utility patent lasts for 20 years. When you talk about a design, we mean maybe the design of a vehicle, the design of a machine. But when you talk about a plant or utility patent, we are talking of a big plant. We are talking of what a huge plant of invention, and then this has to last for more than 20 years. So again, what do you mean by trademark? So when you talk about trademark, we mean here a trademark protects a symbol. When you come up with a symbol, you'll have a protection right to that symbol. So a trademark protects symbols, they protect words, they protect designs, and protect phrases that identify products made by different parties. Trademarks apply to logos, they apply to brands, they apply to names, they apply to slogans. They do not expire and usually last until the owner no longer requires them. So when the owner of the trademark no longer requires these trademarks is when they will expire. So we've done trademark, we've done patents, we've also done we've done the copyrights as well. So let's go back to current assets. So we are done with the intangible assets. So let's see, now we have the natural resources. Let me go back to non-current assets. So now we have the natural resources after intangible assets. So again, we are asking, what are natural resources? So when we talk about natural resources, we mean natural resources are assets that occur naturally and they are derived from the earth. So a natural resource is a resource that occurs naturally. They are derived from the earth. Examples of natural resources include timber, we include fossils, we include oil fields, and we include minerals. So these are natural resources and we are calling them non-current assets. Turning them into cash will take a longer period of time, will take more than 1 year. And when they take more than 1 year, we call such kind of resources non-current assets. Again, we are saying natural resources are also called wasting assets because they are used up when they are consumed. Oil fuels will use when we consume them, we waste them. Timber, when we use, we are wasting them, so we call them wasting assets. The assets must be consumed through extraction from the natural setting. See, I think this one is self-explanatory. And then, for example, natural gas is an example of a natural resource that must be extracted in order to be used. So natural resources you must extract in order for you to use. And then we're also saying that natural resources are also called wasting assets because they are used up when they are consumed. So that's all the explanation about natural resources, and we've explained into details about the non-current assets. We've talked about the tangible assets, the tangible assets, the intangible asset, and the natural resources. So I hope, ladies and gentlemen, you understood what non-current assets is all about. So we'll stop at that, and then we'll meet on the next video. So thanks a lot for watching. So let's come on the next video, and we'll talk about something else on the next video.